The financial markets are constantly moving, and there's a lot of people telling a lot of different stories about that. But today, I want to look into this a little bit and see if we can't make sense of it, because the reasons for this are both wildly simple and maddeningly complex at the same time. This is something that causes a lot of confusion. It's pretty obvious that something is happening. There's really no point that a stock, or really any other security price, isn't moving. But figuring out what's actually going on and why the stock market isn't just another form of fancy gambling isn't always quite so easy to tease out. On the surface, it's pretty darn obvious why stock prices move. Stuff happens. We're constantly bombarded by new information, and at least some of that information is relevant to stock prices. We may not be able to know which way the markets are going to go, but we know they're going to go somewhere. And this is 100% true. Not even true as far as it goes. This is just true. The markets move on new information. There's a lot of nuance at play here. And understanding the mechanics is really useful for figuring out how to design your portfolio in a way that fits with the rest of your retirement plan. So let's dig in. And it's worth starting from the beginning here. What are stock prices? Well, at their heart, stocks are really just worth what everyone agrees that they're worth. If we want to really peel back the onion, they're the sum of the expected discounted values of all of the company's future dividend payments. There's a lot going on in that sentence, and it's a little beyond the scope here. But if you're interested, take a look at my workshop, Why the Markets Work, in our membership site, the Retirement Researcher Academy. But the upshot is the price of a stock, like pretty much everything else, is what people are willing to buy or sell it for. It's easy to forget that the stock market really is just a market. A massive number of people coming together to buy and sell a lot of stuff. The same with all of the other types of financial markets out there as well. As we talked about in our video on the efficient market hypothesis, investors look at all of the available information out there to figure out what they think a security's price should be. And then they trade on that. If they think that Apple's stock price is too low, they're going to go out and buy it up. And if enough people agree, the stock price will also come up. And remember, all available information really does mean all available information is in stock prices. It's not just the facts about the company. Investors are looking at everything from what last year's numbers were to what's going on in the broader economy to what people on Reddit are saying about the company and how that's being interpreted by other people. And then on around the wheel. And importantly, investors aren't really buying the past. They're buying what they think is going to happen out into the future. What's happened in the past is certainly valuable information, but it's already known, which means that it's already been incorporated into the stock's price. And this is where prices move. Because as we said, stuff is always happening. And a lot of that stuff is going to impact either the economy as a whole, or a specific industry, or just a specific company. It could be as major as a company declaring bankruptcy, or even as minor as the CEO having a bad hair day. But that new information is always there. And all of this, the big important stuff, all the way down to the stuff that probably should be irrelevant, are driving price movements. This is because investors were wrong about what the future would look like. Remember that I said investors care about the future. Security prices include a whole bunch of expectations about that future. And a lot of those expectations are wrong. Now, this isn't some big indictment of investors. It's impossible for them not to have been wrong. We can't perfectly predict the future. We can make some big statements. Apple's probably going to release a new version of the iPhone next year, but exactly how many of them will they sell? Is the Vision Pro going to be another Google Glass? Or will normal people actually end up wearing them? And as these questions and all of the others get answered, or we just get new information about them, everyone's models need to adjust. Investors reconcile their models with reality. This is a crucial point, though, because they already have models about what they think will happen in the future. Prices don't move simply based on whether something was good or bad. No, prices move based on whether whatever happened was better or worse than what most investors expected to happen. It's pretty common to see something bad happen to a company and then the stock price go up because it wasn't as bad as what people were expecting to happen, and vice versa. In fact, one of my favorite examples of this was something that happened to Apple a little more than 10 years ago now. In the fourth quarter of 2012, Apple had a quarterly profit of more than $13 billion. That's billion with a B. This was back when they released the iPhone 5 and one of my favorites, the first iPad mini. At the time, this was the second highest quarterly profit for a company ever. Now, with this lead in, you can probably guess where this is going, but it's still shocking. So Apple released their numbers on January 23rd. And then what happened? Well, this happened. Apple's stock price dropped by 12% in one day. That's not really what you would have expected to happen after announcing the second best quarterly profits ever. But the reason for this is pretty straightforward. Investors thought the numbers would have been even better. So when Apple's profits were only $13 billion, everyone had to revise their estimates of what Apple was worth down. So how is understanding all of this useful to you as an investor? Well, even though knowing why the markets move isn't really going to help you predict which way the markets are going to be moving, it will help you understand what you need to focus on and why those are the things that actually matter. And a great way to learn about what you should be focusing on is to download our free ebook, The 9 Principles of Intelligent Investors. You can download it for free by going to retirementresearcher.com/principles. So you're on the screen. And we've also got it linked down in the description. This will help you take this framework for how the markets work and understand what to do with that in a practical sense. And then what that means for your investment portfolio. If this was helpful, be sure to like this video and subscribe to our channel so you can see what we're up to. If you have any questions on this or any other questions that you would like me to address, just drop them in the comments below. You can check us out on the web at retirementresearcher.com and make sure to sign up for our weekly newsletter to keep up to date with everything that we're doing.